A very good afternoon to everyone. As we all know that financial reporting is an important tool in the hands of an entity. It contains vital information about an entity's health. Financial reports are used by stakeholders to track performance of an organization and for taking informed decisions. So with this, I would like to welcome all the participants in the today's webinar on financial reporting fortitude, unmasking common errors for excellence in financial reporting. We have amongst the presence of our dynamic chairman of research committee of ICI, CA Dr. Anuj Goyal sir. Research committee is blessed to work under the able chairmanship of CA Dr. Anuj Goyal sir. CA Dr. Anuj Goyal sir is a practicing chartered accountant and the Central Council member of the Institute of Chartered Accountants of India. He has made significant contributions in the profession with his extraordinary tenure of 17 years in the Central Council, 3 years in the Regional Council, and 6 years in the branch, including chairman of the Central India Regional Council, chairman of various ICI central committees, and member of editorial board, and so on. He is a self-motivated, enthusiastic, and hardworking person who has proved to be a great source of motivation, specifically for the youth. His contribution in the field of research and development have always been remarkable. Now, I would request CA Dr. Anuj Goyal sir to please address the participants.
Thank you very much. Am I audible?
Yes, sir.
Yes, sir.
So, a very good afternoon, friends. I'm really very happy that we are having this very important webinar on very important topic, financial reporting fortitude, unmasking common.
I think Rahul, we lost sir's connection. No?
Yes, there is some error, technical error. Sir has joined again, sir.
Since 1958 is having ICI Award for Excellence in Financial Reporting, and it is an award ceremony, the recognition, which for which each and every corporate to look for, and we are trying our level best to see that how we can handle the stakeholders, the corporates, and can try to communicate them that what are the common errors due to which they are not in a position to be the part of that awards. And I am quite confident that when we are having the best of the resource.
There is some technical error, I think, on sir's part. He's joined again.
I think they will be the best position to see that how I communicate to the CFOs of the respective companies, the chartered accountants who are taking care of the financial statements of the various entities, as well as the consultants, as well as the doctors who are taking care and auditor to see that how we can have the best of the financial reporting. And I'm quite confident that as we are having resource with Maswari and Puhari with the help and support of both of them, I think a lot of things which we must be ignoring or which we were.
Sir is joining, I think.
And I will not be taking up further some technical problems there. Welcome all our honorable members from each and every part of the globe, I will say, and I once again welcome our honorable officers of the research committee and both the resource person, Ankit Maheshji and Kuldeep Kothari. Thank you. Thank you.
Thank you, sir, for your valuable words. We have amongst the eminent speakers who are a great source of knowledge, CA Ankit Maheshwari, sir, and CA Kuldeep Kothari, sir. CA Ankit Maheshwari is a highly accomplished and dynamic chartered accountant with an exceptional track record of over 15 years of professional experience spanning geographies, with a strong focus on enhancing financial reporting framework of large listed companies in India. Ankit sir has established himself as an expert in the assurance. CA Kuldeep Kothari sir is a fellow member of the Institute of Chartered Accountants of India. He has expertise in the field of FR framework, ESG reporting advisory, direct and indirect tax litigation, investment and startup consulting. He is the author of various books and has delivered lectures on the topics like FRF, income tax, GST, investor awareness, and personal finance. I would like to request CA Kuldeep Kothari and CA Ankit Maheshwari to start with the today's session.
Thank you so much, Rahul, for a very warm introduction of both for myself and Kuldeep. Let me first place my sincere thanks to CA Dr. Anuj Goyal sir. Irrespective, he's so remotely located. He's amongst us by whatever means he could have joined. He's in a very important schedule of the institute, and sir, we sincerely thank you for enlightening for 2, 3, 4 minutes. Irrespective, the voice was not audible, but I would say that the kind of enthusiasm and the transparency Anuj sir has brought into the entire research committee makes us or pushes us to take this session forward, because I'll give you a background of it. There were lot of queries which research committee and Anuj sir and that his team was receiving, as far as why a particular concern is selected for award, why somebody is not selected for award. Anuj sir, we will speak very transparently today on what kind of practices the companies have been following. But sincere thanks to you for giving us an opportunity to work so closely with research committee since some time. I would want to also place my thanks to my co-speaker, who is who is the person who has been supporting this entire endeavor, CA Kuldeep Kothari, in enlightening
Thank you, Ankit.
all the corporates for better reporting practices, best reporting practices, impeccable reporting practices. That's what I would want to say. My sincere thanks to our secretary, Dr. Amit Kumar Agrawal ji of the research committee on making this happen at such a short duration, because we wanted that this seminar should take place. Reason being that a lot of companies are also in the process of annual reporting practices. Last time when we did this activity, almost half of the companies were out with the results. So we thought that why not be proactive and why not come out transparently on everything. All your doubts will be entertained. Here, I assure you that we will not take any diplomatic views. We will come up with straight views. My sincere thanks to Neha for she's been working so hard about every compendium, research committee issues, every error. We internally also deliberate every solution to the error. Neha has been a flawless resource. Neha, thank you so much for helping us out doing all these things. And Rahul, the young budding chap, he's learning and he has learned a lot of things. Rahul, we also learned a lot of things from you. The compendium on the excellent reporting practices for public sector undertakings, Rahul was a key resource helping us drafting that compendium. Thank you everyone and finally thank you everyone from the corporates as well as from the auditor side for joining this webinar. And I and Kuldeep, again on behalf of Kuldeep, I am again assuring that there will be no diplomatic views today. Whatever questions you want to pose, why I do not get an award, why we do not get this recognition, why somebody gets a recognition. So this session, Neha, we have tried that we will not keep it texty. We will only share annual reports, only practical expedients, only practice of reporting practices of each and every entity. Somebody who has got an award, somebody who has not even applied for an award, somebody who has not got an award, I think let's come out transparently on each and everything, and that will be the core objective of the entire session. We want it to be a very interactive session, and we want that each and everybody's aspirations from the session fulfills. 2 hours is a very short duration to deliberate on any annual report when we talk about the non-financial portion and financial portions both, but we'll try to cover the common pitfalls. That's what we can, in a paucity of time, we can do, and then we can reach. We can do this again. You can reach to Neha, Anuj sir, anyone, even both of the resource persons, I and Kuldeep, for any queries you have pertaining to this. Over to Kuldeep for quick introduction. Till that time, I start sharing the presentation, and the presentation has no text. So please, no text, no laws, nothing. Only the snapshots of an excellent reporting practice and an average reporting practice. Also, those corporates who are attending, I would also want to say, please don't take it as a positive or negative out of it. Right? It's just what has been done, what is the standard practice, and how we can enhance that practice. That will be the entire objective of the session. So no offenses to anyone. As I told you, we'll not take a diplomatic view. So you also take no offenses to anything as to when we start discussing those practices. Over to Kuldeep ji.
Thank you, Ankit for this wonderful introduction. Again, on behalf of me, Ankit, and the whole team, Anuj sir, I would like to place my warm thanks towards you for giving us this opportunity and for working tirelessly for the profession day and night. Honorable Secretary Amit Agarwal ji and whole research team. Anuj sir, I would quote your words which you used to say to me every time, that it is not always about awards, it is about excellence. And that is what we will try to depict in this session, that what excellent practice is. To benchmark, we have kept some annual reports of awardees as well as the non-awardees, so as to clear the doubts in the minds of the participants, that whether and why I have not got an award, and why should what is the standard practice of evaluation, as well as what are the standards and what is a best or excellent reporting practice indeed. So without taking much time, Ankit, over to you to initiate the
Thank you.
proceedings, and they'll
Right.
have a very interactive session.
This is going to be a joint session. Rather, I would say joint session between I, Kuldeep, Neha, Anuj sir, and all participants.
Yes, sir.
Right. So as we named the session while we were looking forward to deliberate on it. So it talks about unmasking common errors for excellence in financial reporting. 3 agendas we cover today. One, the excellent integrated reporting practice, and I'll tell you a background of why we cover this agenda. So while we talk about a financial reporting award, I'll tell you the structure of the institute also. So institute has 2 committees. One committee is the research committee, which takes care of the financial reporting excellence awards, excellence in financial reporting awards. There is another committee coming up with non-financial disclosures, taking place, which is the sustainability committee, and they also, picks up best practices with pertaining to sustainability reporting. But non-financial information and financial information needs to be presented in a cumulative way. That is why the research committee also gives a lot of weightage on non-financial sections of the entire annual report. I'll tell you the first common error, Kuldeep ji and Neha, and to all the audience, is lot of companies who apply for the award only present their financial statements to us. So when I say only present the financial statements, the non-financial information, be it your chairman's speech, which you give in your AGM, be it your management discussion and analysis, be it your corporate governance report, be it your BRSR report, and most importantly, your integrated report, everything has a lot of weightage which was not happening previously. So that is why majority of the companies who excel well in financial reporting practices, they are very conscious about the adoption of their Ind AS practices. They're very conscious about putting companies Act disclosures in place. Feels that we are not getting an award, and I am telling you a bottleneck to this is a lot of weightage is given for the non-financial section. So everybody who is sitting from their finance team, I would want you to request your corporate reporting teams, the IR teams also to join such sessions, because then only they can connect to what we are trying to say on the non-financial part. So that will be the agenda one. Uh, the approach to integrated reporting. The agenda two will be the financial disclosures and the common pitfalls in common errors in financial disclosures, or a standard disclosure vis-a-vis an excellent disclosure. That will be the agenda two. And third, as rightly told by Kuldeep ji, we will try to, let's try to, uh, should I say this, Neha? Let's try to trick the, reviewer. So sometimes if you're looking for an award, you have to look it from reviewer's perspective. And uh, and trust me, when Neha receives all these applications, these are like 300, 400 applications. Entire research team starts following up. The last day to take this was this time 15th of October. And averagely, every technical reviewer, institute and panels, 70 experienced technical reviewers. Before this move to head technical reviewers or chief panelist or the jury, there are 70 technical reviewers. But still, the time paucity is so much that each and every reviewer will not go into detail of everything, but the broad aspects of your reporting practices. That is why I said, if I am you, if I am a corporate, I'll try to benchmark the reviewer's perspective also while preparing this report. That if a report is given for a span of say 3 to 4 hours, then how in 3 to 4 hours, your best practices can be highlighted well. So that will be another thing. So that these are the three agendas with which we start the entire session. I'll straight away come without wasting any time. I'll straight away come with integrated reporting practices. And I want, use your chat boxes well. So because there's a lot of buzz around integrated reporting, there's a lot of weightage which Neha and team gives to value for value creation model, business model, allocation of capitals. And that is why this is something which I really wanted to deliberate. Now, uh, now my question to the audience is, what is your understanding of integrated reporting? And Neha and Rahul specifically, you have to
Yes, sir.
moderate for us, right? I want to know what is your understanding of integrated reporting. Because when I move around various corporates and Kuldeep moves around various corporates, I have received, basic answers like it is integrating a financial and non-financial information. It is integration of a sustainability report into annual report. These are some common answers which come to our, our minds. But my question is, if uh, any person who intends to prepare an integrated report, this session is very useful for them. If you are already preparing an integrated report, this session will turn out to be, a lot more value adding. That's what I can assure from research committee's behalf. But my question is, what is your understanding of integrated reporting? And Kuldeep ji, I am posing this question purposefully. Some people who are there, some people in this audience are IR heads and would definitely say what kind of basic question Ankit is putting up, right? But looking at the reports of almost top corporates of the country, I will not name anyone. I feel the clarity on integrated reporting is something which is primarily missing. Yeah, do we have any answer to this?
So, sir, no answer as of now.
So my answer, Kuldeep ji, today will be what IIRC prescribes us. Before an answer comes, let's go into the background of integrated reporting. In 2012, integrated reporting was introduced, and this was an initiative taken by IFRS Foundation. ICI being a member of IFAC, ICI being a member of IASSP also wanted proactively worked upon it, and various regulators were involved, various stakeholders were involved, and India then eventually in 2017, SEBI came up with a mandate of integrated reporting, which we will discuss. But on a global level, this is governed by IFRS Foundation. And initially, while IIRC came up, it was governed by Value Reporting Foundation. And from Value Reporting Foundation, it is governed by IFRS Foundation. And when you look at ISSB, so at a global level, now ISSB also got merged with IFRS Foundation.
Mhm.
That is what instigates them to put up now sustainability disclosure standards. So so IFRS S1 and S2, which we are too much talking about, comes from IFRS Foundation only. However, both the standards talks about only the sustainability and TCFD related disclosures, but the governing principles, and when SEBI mandated this, the governing principles came from IFRS Foundation only, which I and Kuldeep will definitely want to go into detail. But my point is, why integrated reporting, and what is your understanding of an integrated reporting? Neha, we are unable to hear you.
We have two answers here.
Yes.
So, Mr. Mukesh Kumar from India is mentioned. IR is capturing value
Mr.
creation in six
Mukesh Kumar
capitals.
from Vendit India.
Right, from Vendit
That's
India.
what, right.
Right. So IR is capturing value creation in six capitals for the organization. And we also have another answer from Mr. Anuj. And he is mentioning that it is comprehensive reporting.
So that's what I am saying. So Neha, that's where the confusion starts, right? A FMCG conglomerate puts up an integrated reporting with their sustainability report, right? Another FMCG conglomerate, I would say peer to it, puts another form of integrated reporting, which is embedded in their annual report. Some people are issuing integrated reporting as separate reports. So an integrated report is a separate report. And some people are issuing it as a part of their annual report. There's a lot of confusion going on that as to how this integrated reporting needs to be embedded into the reporting structures of the company. Now, my point here is, let's go more detail into it. And the next slide which I present, and thank you Mukeshji and Anujji for being participative into it. But the next slide I am preparing is a bare law. So what IFRS Foundation think that what integrated reporting is. IFRS Foundation mandates that an integrated reporting is integrated thinking. Mukesh sir, I completely agree. Yes, it is a six capital approach. Yes, the business model. It is a part, it is the content of the integrated reporting. But when IFRS Foundation released their publication, they came up saying very strongly about a terminology called as integrated thinking. Now this is Act what IFRS Foundation has published in their literature. What is integrated thinking takes into account the connectivity and interdependencies between the range of factors that affects an organization's ability to create value over time. I will reiterate to my learned audience, when we talk about integrated reporting, when we prepare integrated reporting, we have to really look into whether my integrated reporting on all the matters, on all the 8 core elements which I and Kuldeepji will deliberate on each core element, whether my integrated reporting is able to depict the values in 3 tenures. That is the short term, medium term, and long term. And whether the changes in these capitals, whether your materiality assessment has been done as per those three three goals which we have kept it for short term, medium term, and long term. So now I read this further. That's what Mukesh ji told. So they're asking about the capitals that the organization uses or affects and the critical interdependencies, including trade-offs between them. So a lot of people are able to depict their capitals as we progress in their session, but two common errors. One, they're not able to depict it as to what value these capitals are creating over a period of short term, medium term, or long term. Or there are there are cases where the trade-offs between financial capital and intellectual capital, how do you depict that trade-off, is an art. And believe me, friends, no branding consultant on this planet can tell you what, or even I and Kuldeep or anybody can't tell you how your financial capital gets a trade-off between an intellectual capital. Somebody who is core in this, core to your business, can only help you to prepare this. That's rule number one. So lot of this comes from, the problem comes from these integrated prepared by uh, branding companies, non-professional, I would say, and they're good at graphics and contents. They are good at benchmarking it to some peers, but they're not the. We being chartered accountants, everybody sitting here, I'm assuming, is a chartered accountant. We understand what is the intent of the law to put behind any framework. So that's something which I would say, or to all those who doubt why my integrated reporting framework did not got an award, were they comparable? How many of you were able to prepare a comparable integrated reporting framework? Were they able to signify what is the trade-off between your financial capital and a natural capital? How are they compensating each other, and how, what is the trade-off? So that's point. So the next thing, which is identification of stakeholder needs, lot of companies are doing this very correctly, and I would say the correctness behind the stakeholders identification is because of the mandate which comes from BRSR. The third is that how a organizational business model and strategy responds to the external environment and the risk and opportunity it faces. Kuldeep ji, we were having discussion with about that conglomerate. So they were able to present, what they are doing, but how they are responding to an external environment should be embedded at the integrated section of the annual report. When I say this because external environment is mapped lot of places. So when I say external environment, I'll tell you the first core element of integrated reporting, and that is your organizational overview and external environment. So what mandate IIRC gives us is to capture these things. The first thing which we need to capture is organizational overview. When
Recording in progress.
when I say organizational overview, so this comes at your corporate overview section of your annual report. This is also coming at the sustainability report, which you are separately publishing in compliance with BRSR. This is coming majorly in compliance with SEBI LODR requirement when you push this information in management discussion and analysis. I hope everybody will agree on the fact that these are 2-3 places. Now, if you are integrating your integrated report with your annual report, this is the section to start from, that you talk about your organizational overview. When you publish it with any other report or separately, this becomes either redundant, or you feel that I have already put it in my sustainability report. What is the requirement to put it in the integrated report? Or I have put it in a MDA. What is the requirement? See, it's a framework, and all the requirement needs to be complied with, making sure that the report doesn't get bulky out of it. So the idea of this session is not to make your report bulky, but to make it more crisper, but rightly referenced. But but an integrated report cannot be completed without an organizational overview with an external environment mapped to it, be it you are publishing it as a part of sustainability report, or maybe you are publishing it separately or with integrated report. Don't miss on that fact, because that's first content which needs to be captured. And Neha and her entire committee has weightage to this entire section also, when you talk about how are you presenting this. So next is uh, so the respond to the external environment and mapping it, and the risks, the internal risk and the external risk. A lot of people map their risk as per integrated reporting framework. The mandate is to map it internally as well as externally, and the performances, right, in terms of um, activities, which we will discuss it. So that's the entire concept of integrated reporting, integrated thinking, and just don't confuse it with any sustainability report. Yes, the governing organizations are same, and there are a lot of things which are uh, coming as a part of M also, but it is a separate reporting structure and needs to be reported in that fashion only. Kuldeep ji, anything you want to add on this?
Ankit, before we move on to the next portion, I would like to pose a question before you from all of us participants as well as the team. That what is the basic difference between a sustainability report and integrated report? To brief you and brief others about why this issue came in my mind. If you remember, while we were deliberating on the commonly found errors last year, we were talking constantly. We were talking about MDA being compromised after introduction of these thematic-based annual reports or integrated reports. And now, what I've seen this year is that integrated reports being compromised because of they are being mixed with the sustainability reports. People are like presenting integrated and sustainability reports, or they are giving mortality assessment separately. Some companies are giving separately for integrated reporting, some are giving for BRSR, some are confusing it with BRSR also, because BRSR is a report which is mandated by the statute, and it was made applicable from the last year only. So what is the basic difference? And as a company, as a corporate, or as an auditor, how do I differentiate between these two things? Because what I've seen while reviewing the reports, this is the basic problem. What we used to say about MDA, that it is a statute-backed requirement and it is being compromised on account of preparing thematic or good-looking annual reports. I am seeing the same for integrated reports. So if you can answer this for us, it will be a great help to all of us.
So one thing, as I told, that the structures are, the mandates come from two different authorities, right? Uh, number one, integrated reporting is a voluntary framework as of now. BRSR is mandatory on top 500 companies of the country. I'll share the mandate. Integrated reporting, it was mandated by SEBI in 2017, and it was applicable on 100 top 1000 companies voluntarily. Another important thing, after the session, lot of companies might feel to go for an integrated report. I'll caution you, once you go for an integrated report, you can't come back. Rather, I'll share information. Some of the company published, their annual report at with stock exchanges, saying that please find the attached integrated report for XYZ company for 2012 20 to 23. Now that report was not integrated report. So, so the language of the letter itself says that we have started publishing an integrated report. So as of now, SEBI's framework is not applicable unless you are not publishing. The moment you publish it, then there's an advisory of SEBI based on which you have to publish it, and you can't go back. You can't decide that this year, okay, let me publish an integrated report, and next year we can go back to the normal reporting practices. This can't happen. So once you start publishing it, or you claim that you are publishing it, you have to prepare that in compliance of the law with SEBI mandates, and preferably in compliance of the IFRS foundation. So the distinguishment is the mandate. One, BRSR comes from a typical mandate of SEBI. BRSR is a format in which you find book Annexure 1, Annexure 2, Annexure 3 attached to it. BRSR, only thing you can do is about, your defining your approach to BRSR. That's where you can play on. Else the entire report is a standard format report. There are certain informations pertaining to your social and relationship capitals, pertaining to your natural capitals, pertaining to your human resource capital, which are captured, in sustainability report, and the same is also captured with your integrated reporting framework. But additionally, integrated reporting framework talks about financial capitals, manufacturing capitals, to certain extent intellectual capitals. A lot of information is not captured as a part of BRSR. Also, BRSR, the value creation models and everything which we will talk about, these things are not a part of, the sustainability mandates. As far as ISSB are concerned, yes, they talk about the value creation models. They also, in our also Annexure 2 and 3, talks about how are we creating value over a period of time. So there's a huge distinguishment. Please don't mix it. And mixing, I agree to Kuldeep ji completely. Mixing makes it more tricky. Somebody I have seen has prepared a materiality matrix based on the ESG requirements. So where are the other capitals, and how do we map the other capitals? So there is definitely a differentiation, and as corporates, everybody should realize this, that integrated reporting is not a substitute to sustainability report. Neither sustainability report is a substitute to integrated reporting. However, they are interdependent. The identification of stakeholders, there are certain stakeholders which are which are common for both integrated reporting frameworks and the TCFD reporting frameworks and the sustainability reporting frameworks. Kuldeep ji, anything you want to add? I am sure you know the
No.
answer to this.
Maybe we can carry on.
Okay, so let's gear up with integrated thinking approach. Now so let's start integrating the thinking of all these capitals, and here we move on the next part. So Kuldeep ji, when I'll start from most basic things I see in evaluating a report, and research, we are blessed that research committee has trained us so well that sometimes whatever documents Neha and team sends us, Neha, I go back to the portal and start looking at that, while ICA is giving an award to this company, whether it really deserves an award or not. Now, this is a snapshot of some company which has disclosed which has uploaded their annual reporting in this format, where you can see what kind of asynchronized information is coming up. Now, institute wants to see the information in a very synchronized way. This is not the way to upload your annual report. I would say if somebody has to do it, I'll give you the ways to do it. But how you are putting up this information on portal is also very important from our point of view. So it cannot be in asymmetrical way. It should be easily accessible. So somebody who wants to access all your three reports, be it integrated annual or sustainability report, should be able to access it in a very easy way, right? There's no point putting up information for year 2002 as of now, right? Uh, it doesn't make too much of sense. So when you upload your information, make it sure that it is easily accessible. Not necessarily whatever information research committee pushes to a technical reviewer is the only base. We take other base also, and that's one base. I would say that your placement of annual report is important, because a lot of people complain, you have not seen this, sir, आपने वहां जाके नहीं देखा. So I am telling you, nobody has that much of time for you, that somebody will go navigate your portal, go into details of it, and pick up a sustainability report separately, pick up a integrated report separately. Please make it accessible, and if you do that, you will see that things become easy, and you score also well on that front. So that's one thing. Please start placing your investor communication things. Please be very sensitive to this issue also. Forget award. it's a sensitive issue. As to tomorrow, if a regulator wants to go and access an information, how does somebody access it? I was saying something that, benchmarking Tata Group of companies would be a good practice, where, all investor communications are done in a very synchronized way. Majority of the companies I see with Tata Group of companies, and I take a lot of pride in saying that, because they have a legacy of 120, 125 years, which is reflective on their investor relationship section. We'll move detail into it. What could be an excellent reporting practice, but let's go to integrated reporting section. Now, as I told you that let's try to benchmark the reviewer's perspective. Kuldeepji, there comes an integrated reporting. I hope everybody is able to view this entire table of content. I have put a table of content because first thing which you have to do while you prepare an integrated report is benchmarking a right table of content, right? So now, before I go on table of content, Kuldeepji, I want to deliberate with the learned audience on the 8 core principles with eight core elements which somebody is expected to capture. Also, let's look into SEBI's advisory on integrated reporting, their advisory. Before even you think of preparing an integrated report, let's look into the law first. So the IIRC framework asks you to prepare an integrated report on 8 core elements, right? The first element we were discussing is the organizational overview and external environment. The second is the governance and the governance structure. So please check whether your integrated reporting is capturing this. Also check whether the table of content which I show you here is able to capture this when they claim that it is an integrated report. Another thing before I deliberate further on the core element, Kuldeepji, common problem I found a lot of integrated reports of larger companies with MDA sections. This is a wrong, again I am saying, with corporate overview sections, with BRSR section. When you look into the guiding principle of integrated reporting, and when we move down, I'll tell you the guiding principle also. The integrated reporting should stand out as a part of any communication. If you are saying that I am complying to a IR framework, also don't do this mistake writing if you are complying to an IR framework, or you have benchmarked the report as per GRC, or you have benchmarked your report as per ISSB, then whether truly it is benchmarked or not, that's something which we should take care. As evaluators, we definitely look into this part. But my suggestion, please don't merge your corporate overview and integrated reporting together. Kuldeepji.
I have a question, Ankitji, here. That when you say that I should mention that with which framework or which standard I have benchmarked my integrated reporting. So a random question comes in my mind: is it possible that I am presenting an integrated report and I am claiming that I have benchmarked it with the ISSB standards, or it has to be benchmarked with IIRC framework? Is it possible? Because I have seen it in many reports. They are writing that they have benchmark, or they have complied with the sustainability or ESG standards or ISSB standards. Is it possible?
So I'll answer this. I'll give yes or no, but I have an entire slide on what people are writing. So I am keeping it for both of us to deliberate later. But no, the primary answer is no, right? The framework which an integrated reported is expected to be benchmark is the integrated IR framework, which we will discuss about. Rest, your entire report can be benchmarked with different frameworks, which you can certainly talk about. But I would want to detailedly deliberate this when we move ahead with this session. So next is which is expected to be captured as per IR framework is the business model. So in this entire table of content, find out where the business model is. I am still unable to find out, right? But yes, something which we need to figure out. I'll show you more table of contents post this. Another thing to benchmark is risk and opportunities. And a lot of people benchmark this as a part of their ESG also. A lot of people benchmark it as a part of their MD also. How do we integrate into this? That's something which we will deliberate from here. The next element is strategic and resource allocation. And here you see, the company talking about their strategy building towards an integrated report. Still, I would still give them some weightage to it. But what is the strategic and resource allocation section, and how do we benchmark it? That's something which we need to look. Then the sixth part is the performance of capitals. And Kuldiji, I am surprised to see that people, while they say they have benchmarked it, I found very limited companies talking about performance of their all six capitals. They just talked about, disclosed the numbers of these six capitals. And in some companies, when we push this report forward, you will not even found the numbers. However, this company, table of content which appears on your screen, is able to talk about these six capitals well and is able to benchmark it well. The next is the outlook, and the last is the basis of preparation. That's what an integrated reporting framework is expected to capture. Now, this comes out of a table of content of a manufacturing sector. I move to another table of content who claims that their integrated reporting is prepared. The entire table of content is not able to give a structure as to where the integrated reporting is. Finally, we found it with their sustainability reports. But now, in this also, the section of integrated reporting needs to come out very well. My thrust is, how do you how do you distinguish your integrated report with your other communication? I think the focus has to be on it, capturing these 8 core elements which I talked about: the organizational overview, the governance, the business model, the risk and opportunities, the strategic and resource allocation, the performance of capital, the outlook, and the basis of presentation. So, so that is why the research committee starts underscoring you right there. So when some technical reviewer does not even find it on the face of the annual report, the problem arises. I am not denying that it might not be inside the report, but you have to make sure, in compliance of IR framework, that the navigation of this communication is also important. So here, this comes again. Again, it was a FMCG sample. This is again a FMCG sample. Uh, Still, the framework of integrated reporting not coming the way I was talking about. There comes another sample, and here the company has talked about their capitals. The company has talked about the value creation model. Looks less cluttered, but the framework still needs to be benchmarked. And I'll give you examples of uh, all the industries from the awardees point of view, that whether you are an insurance company, whether you are a banking company, whatever I have tried to look into details of it, and I was not able to find. Now this is an integrated report. When you say a corporate overview section, when you say a statutory report section, uh, why not an integrated reporting section? So this comes out from banking. And if I have to benchmark somebody's table of content, Kuldeep ji, I think this is an excellent practice. I would give full marks in writing table of content to this company for making sure that their integrated reporting section is coming out well. Also, the approach to integrated reporting has come out well, and that's one top reasons that this company also was awarded by the sustainability board. right, for their excellent sustainability practices showcased in their annual report. But you see all these things which we were discussing, right? A majority of them are covered as a separate section. That's how I look at it. Kuldeep ji, if you have any point of view, I would want to know that.
नहीं नहीं
Okay. So,
नहीं I
so
just
now,
I'll
sure, please.
I would just like to repeat what I've said. What your report, a good-looking report, you lose out on the front of compliance with the law, as well as integrated reporting is not as such that it is an media game. It is all about benchmarking with the standards which an international council has issued. So it taken care when you prepare the integrated report that as basic as a table of content, as you have rightly deliberated for all of us, that it is of the same importance, the importance that you are giving to presenting your value creation model. So over to you, Ankit ji.
So last thing, I again reiterate the bare law, Kuldeep ji. Today I will only reiterate what the framework says, what committee feels, why somebody is awarded, why somebody is not awarded, is something which is a byproduct of the entire exercise. But this is IR's framework as it is language. The IR framework takes a principle-based approach. So IR has clarified this, that there will be no reporting requirements we have, right? Or to be specific, they will say that they are saying that there are no KPIs or there are no measurement methods, but there are some reporting requirements if you say that you are applying a IR framework. So one, the intent is to strike an appropriate balance between flexibility and perception. So yes, IR talks of giving you that flexibility, but in the second line, they talks. This is the law which this is a framework which says that it does not prescribe any specific key performance indicators, but it has some small number of requirements, the 8 core elements which I am talking about. And now, very important thing, Kuldeep ji, this will answer to this. And that's what you asked, what is the difference between sustainability? How do we place an integrated report in the entire section of an annual report? The framework says an integrated reporting may be prepared in response to an existing compliance requirement. So now once you start adopting it, there's an existing compliance requirement which comes out of SEBI's mandate in 2017, which I am discussing just post this, and maybe either a standalone report or maybe included as a distinguishable. Please now read this law. That is why there was a clear deliberation of table of content, and that is why I gave 40 minutes to it. Right? Included as a distinguishable, prominent, and accessible part of annual report or communication. So I think now there is no ambiguity as to, I would still say, if you are even preparing it as a part of other communication, yes, there's a flexibility, but then that integrated reporting has to stand out. And my suggestion, and to my understanding of this framework, to my deliberation with the regulators, my deliberations, our deliberations at even the at the level of value creating foundation, this needs to either be a part of an integrated report or can be a separate communication. Preferably make it a part of your annual report, makes it more easier for you to take it forward. Strict no to preparing it with a sustainability report. That's what my take is. And now I would want to, Kuldeep ji, switch my screen for the SEBI mandate so that any clarification which is required from here, right? What is happening in India and what other things, the SEBI mandate which we were talking about. just give me a minute
Mhm.
to flip my screen because I want to come out with the SEBI mandate. And
So,
before start going for your report preparation, this is the minimum compliance which any Indian company is expected to do. Yes, Kuldeep.
but again, Ankitji, a little bit in contradictory to what you have said, I still believe that if you present the integrated report separately, it will not solve the purpose, because when we discuss the principle of integrated reporting, it talks about integrated thinking. So, in my opinion, it may be, I'll agree to disagree that it may be a case that you are presenting a separate integrated report. But I think if you are presenting it not if you're not presenting it along with the annual report, it will not serve the purpose. It will be just a mere instrument for complying with international regulations, or to be in line with your peers. That is what I feel out of
Kuldeep, we are
this
losing your
past
voice
discussion.
while you are deliberating in between. There's a lag, but I got your point. So I am with you on it. There's no difference of opinion. All I am saying today, I promised while I started with this
Mm,
session that I will only talk what law talks, what I think or what you think or
mm,
what this committee thinks. So even if you're separately presenting, I am saying
mm,
it is in compliance. The preference is, as I told in the session only, is to be presented with the
mm.
annual
Agreed, agreed,
uh, annual reporting, right?
agreed.
Now, now let's look into the integrated reporting, what SEBI mandates. So the key principles which are reported by the SEBI has mandated, the first thing they say is a BRR report. So that's long way. Post that, the integrated reporting uh,
BRS.
IFRS foundation has completely changed. So when you start benchmarking it, this is a minimum benchmark and the maximum benchmark comes from the IR reporting framework. Right. Now, SEBI says today an investor seeks both financial as well as non-financial information to take well-informed decision. An integrated report aims to provide a concise communication. Now, here it only talks about organizational strategy, governance, performance, prospects, create value over time. This is those 8 things which has been now defined as to how each and every 8 element needs to be presented. So the purpose, so now a listed entity, I'll move on, the principles on which this integrated report needs to be based on. And these principles also now have, have been aligned to the specific information if anybody is expected to capture for preparation of an integrated report. So this talks about strategic focus, future orientation, connectivity of information, stakeholder relationships, materiality, conciseness, readability and completeness, consistency and comparability. And that is what I'm saying, that I
Mm,
don't find comparable reports. When you present outflow of your capital, or when you even present the input of your capital, is it coming as a part of comparative information or not? That's something, that's a question which we really need to ask to ourselves. And then comes the framework where, IRC has talked about these 6 capitals. Kuldeepji, I felt a little disheartened that, you know, uh,
mm,
there are some branding companies which are misguiding or the in-house teams are not aware. The approach is a capital approach, not only in context of India. I know you posed this question with Safa also. I know
mm,
this question keeps on coming up, and companies are misguided by some kind of an approach which identifies stakeholders or which identify ESG parameters. SEBI has a clear mandate. If you have to go with any approach, I can vouch it and write it on a stamp paper. It has to be a capital approach model which somebody is expected to follow. This is in compliance to the framework also, right? And then it's a voluntary basis of adoption, as I told you, right? And then it comes that information of integrated report may be provided in annual report separately or by incorporating in MDA or preparing a separate report. So that is what I said. Whatever law says, I abide to it. Even I said that it should not be a part to management discussion and analysis, because the global framework expects me to distinguish the same, and that's what we are trying to benchmark. Uh, right. And this is a statutory regulation, and once you start adopting it, you can't go back to it. Any questions still here? I am more than happy to answer. Rahul, see if you have any questions for integrated reporting.
Sir, no question as of now has been received.
My request to the learned audience is, because very soon we will move to the financial part of the report, discussing few more things. Please pose your questions pertaining to integrated reporting, because we will run short of time. How much time you give to myself or Kuldeep? I am telling you, we can deliberate this for 12 hours, and so put up your questions pertaining to non-financial sections. Please don't miss out that part. Back to presentation. Visible? Kuldeep presentation is
Visible.
So Kuldeep next we come to a very critical point of integrated reporting, from where
Very important.
where you were talking about what is the reporting boundary, right? And as you were rightly saying that, sometimes why this is important, I'll tell you. There are 2-3 aspects to this. So the annual accounts and financial statements, when you prepare a consolidated financial statements, friends, your reporting boundary is the entire company, the group, with the joint ventures, with the associates, with the subsidiaries, with the step down subsidiaries, which has been captured in accordance with Ind AS 28. Your reporting boundary remains to be the same. When you prepare a BRSR report, because a lot of companies subsidiaries prepare their BRSR report, so your reporting boundary might be confined to only the standalone statements, or only the company as a whole, not their subsidiaries. While IARC also talks to frame a reporting boundary. Now, Kuldeep, when we say the bottom line of integrated reporting was, when I was reading the text previous to the slide, that information needs, the peers can compare the information. So if two FMCG starts presenting a report in a similar way, then only the purpose of integrated reporting for IFRS Foundation gets solved, right? Now, I don't see a single company correctly drafting their reporting boundaries for an integrated reporting framework. I have captured some snapshots of various companies, right, where uh, you can see, one company says, Kuldeep, you can read that. The IR report covers the statutory financial information and activities of the company in financial year 2023. Now, is it a reporting boundary?
Not at all. Isn't.
Just look at how detailed the framework is, and look at how simply somebody has defined it. Right? Because maybe the IR teams, or whoever is helping you, just knows that there needs to be a heading of reporting boundary. What kind of impact it has on the entire integrated report, and the report, because when you're giving this statement, you're giving it as a part of your annual report. You are not only giving it for IR, you have to give it for entire report which you have prepared. So next is, the integrated report presents information of financial, non-financial performance of the global operations. Information on our joint ventures have been disclosed as relevant. Any specific exclusion are provided in respective sections. Still a better statement, but ideally a reporting boundary will talk about all those entities who have been included, and more importantly, all those entities which have been excluded. Now the problem doesn't stop here, Kuldeep. the problem starts. So saying that I have adopted it is a easier thing. But complying to the law is difficult. When you say that there is any exclusion of an entity to this reporting boundary, right there you have to disclose the reasons for excluding it from your reporting boundary. It is not like a BRSR report. That's what Kuldeep was saying in the beginning also, that there you are permitted to provide an exclusion. Here you are integrating the entire information and the impact your group is able to create, right? The third reporting boundary comes the out of the FMCG company who is preparing the sustainability and integrated reporting together. And I would say the defining the boundary still remains to be okay, but it is defined. It is defined for the sustainability reporting purposes. A separate boundary needs to be defined for an integrated reporting purpose. Talking about the relationship with the entities, when you look at the framework, there are 8-9 criteria to it. With paucity of time, I can't, but primarily on which of the companies it is applicable and on which are the exclusions, and the reasons of exclusions needs to come here. So I hope we are able to highlight how a reporting boundary needs to be drafted. So we drafted a table of content. We drafted a reporting boundary. That's the first two steps we do, and then I come on another aspect. So while you adopt an integrated reporting framework, IR expects you to get a statement from those who are charged with governance. Kuldeep ji, now this statement is a mere statement, or what the framework intends to capture, we should start discussing that. Now, I feel companies are just giving a mere statement. Look at the entire. When I talk about the law, you want to hear the law first and then the statements, or the statements first, then the law?
I think the law first.
Okay. So this is the law. This is the law, bare capturing of law. It is the acknowledgement of the responsibility to ensure the integrated report. Their opinion or conclusion, to what extent this framework is presented to all board of directors who are giving this opinion. And my concern and my point of risk is somebody from the senior management of corporate reporting teams, when you give such kind of a responsibility statement and when you do not adhere to the framework, see what the problem has happened. Let's try to understand. The problem is, unless you were not adopting it, there was no problem to this. Now you adopted it, and somebody said that there has to be a responsibility statement which needs to be included. You included that responsibility statement. Now that responsibility statement says if you are not able to adopt in full spirit, then you have to give a reason to this. And like in BRSR, now the regulator had started intervening. In this case also, you will see regulatory interference when you give a statement and when you have not adopted the framework in the right spirit. Then what kind of risk you pose from regulator's point of view still needs to be mapped, and from investors' point of view also, because if any investor, if there's an intelligent investor who is looking for some non-financial information, then then he can come back on it that the adherence or the report is not prepared as per the IR framework, and the statement from those who are charged with governance are not able to clarify why a wrong reporting boundary is defined, as to why a company is not under the ambit of it, as to why we are not able to capture any particular capital. So the deviations also needs to be recorded in this entire statement. The third thing is which is important, is the process disclosures. And this is bare law. Again, the framework. Process disclosures are encouraged as a supplement to a statement of responsibility from those who are charged with governance. Give me one company, Kuldeep ji. I would say none of them should get even a silver award. Neha, give me one company who has given a process disclosure. One. And I have 150 audience here.
No,
Right.
one.
I am asking you now, how many companies, please raise your hands. Probably I might not have gone through all the listed companies report, but please let us know if somebody has given a process disclosure as a part to the statement which is coming from those who are charged with governance. There I am awaiting answers. And please tell the company name so that right
Sure,
here
sure.
we take best practice. What Kuldeep ji I have in my hands is this. This statement from those who are charged with governance, and lot of these companies having high aspirations. So
Before
please,
before we get an answer to what you have asked, I'm asking another question and putting up in front of you and all of the audience. That as we discussed earlier, also we often get to hear this from the companies that it is difficult for them to adopt integrated reporting, or they are trying to transit, but there are problems in collection of data, or they may not be able to comply it in 100% status with the integrated reporting framework. So, will the third point of what law have you have presented suffice the purpose that if I'm trying as a forward-looking practice, if I'm migrating to the integrated reporting practice, if there is any data constraint or data point constraint, can I mention that in the statement if it is coming out in the report? First, I will agree to you that I have not also seen in any of the report this sort of statement of process disclosure, but if it is coming out, then will it suffice the purpose?
I have put the names of I have put the awardees disclosure and awardees from the sustainability board also. So so the problem, let's not look at the award. I am telling you, let's look at what kind of risk we stand with. And award will certainly come. It is a byproduct. I know each and everybody's corporate reporting teams work very hard day and night, and they expect accreditations. That's something which is important also. But unless we start elevating those practices, how do we reach to those accreditations? Now, now Neha, did we got any answers?
Not yet, sir.
See, and Neha, how many corporates would be there in the session? 50, 100?
More than that, approximately
400
400,
crossed.
So I hope
nearby 500.
So a little things, small things to think about, and award will definitely come. I can strongly say that the institution primarily tries to work on very transparent procedures. There's a 4-layer system to give an award, but somebody who has picked this point and has thought that the integrated report is not as per the alignment of IR framework. This is where people miss out, irrespective they work hard. To all professionals sitting here, we are not here to benchmark any peers. We are not here to benchmark anybody else. We are smart professionals. We are here to benchmark what the frameworks are, what the laws are, and this entire session will be deliberated in that fashion only. So, I hope I am able to solve a purpose. I don't have a peer reference, Kuldeep, sorry, because a lot of companies, while we personally advise them or even if we technically review them, they ask where is the peer reference. You might be a first mover into this entire scenario, and but if you are benchmarking law, please don't look for any peer references. Law itself will suffice.
And I would say that we should not wait for the regulator to come after us. Why to wait for the regulator to come after us?
I am saying now there is an advisory which the BRSR teams are getting. Right? There is an advisory which an integrated reporting team will get. I am sure that the penal consequences are not coming right away, but in times to come, we have to be careful. That's all. And Kuldeep ji, you posed up this question. I am again answering this. If you really want to go into an integrated reporting, there is an option that you don't go it in a straight away manner. So today, if some company thinks, and that's when I and Kuldeep deliberate between the CFOs of these listed entities also, we say them that let's not go directly into the integrated way of reporting. Let's try to put some information of integrated reporting for 2 3 4 years and then benchmark it to the framework. The framework is also principle based framework, so not necessarily, but as you are claiming it to be an integrated reporting framework, as you are accepting the integrity of this integrated reporting framework, that's where my problem starts. So either let's stop claiming it only. That could be a Kuldeep ji, that could be an easier option then,
Easier
right?
option.
At least neither, and don't say that your it is an integrated report. It is a normal annual report, which proactively your company has started capturing these 6 capitals because they see this framework coming up in the country. So next part to this is a governance, and a commonly found error while people were preparing their annual reports, the governance structures were missing, uh, or even if the governance structures were given, they were not given as per what is the mandate of integrated reporting framework. Kuldeep ji, we will be in paucity of the time, so I'll take 5 more minutes to, and then we will go on the financial disclosures.
Financial.
And but 3 4 things to sum up, right? I have put up a value creation model, right, of various entities. Now this is a value creation model in which, as I told Kuldeep ji, the capital approach is not captured, right? This comes from a global parent also, have justifiable reasons to this. But when you are reporting as per an Indian standard, when you are reporting in compliance to Indian laws, that's something which, everybody expects us to do that. Uh, this is a value creation model in which there is no business model. They talk about business model, but I don't find a business model here. And how do I find it is, you know, uh, this is, as I told you in the beginning of the session only, somebody who is core to the business can only draft this. Somebody who understands the framework needs to, pitch in with him. And that's how an ideal business model is drafted. If you think this is in compliant to the IRC framework, please accept and say that yes, this is in compliant. Uh, a better value creation model, I would say, as I am, taking it forward. And Kuldeep ji, this comes out from the silver awardee, right? And there is a reason to that award and reason for not giving an award. I am just trying to depict the reason. I am still not saying that it is one of the finest models. That is why you don't get golds. Also, one more thing, Kuldeep ji, and everybody they are sitting out. You will be surprised to know that even our research committee is a little flexible, or even our sustainability standard boards is a little flexible in giving these awards. When we go on global level, so Kuldeep himself was moderating the event at Safa last month, and you will be surprised to know that our top banks did not won any gold silvers, right? uh, a bank from Bangladesh, Janta Bank, won a gold award. So because they go by the law, or a bank, or a conglomerate, global conglomerate is winning a gold award. That's how it is happening, and the reason is that we have gone too fancy about our reports. I am not against the fact that we should not put in graphics, we should not put in contents. There's a weightage to it, but let's not compromise law. So here also, yes, there is. See, you find strategic allocation of capitals. Will be certain things coming out slightly in a
Certain
better way, right? The capital inputs, the input of the capital coming out. Uh, the value creation process of this company. I like the value creation model here. This is a personal thing. As I told you, it's a principle-based approach. And what kind of output? What misses is the comparability. Where this company is not
Yes,
able
I
to
was
stand out
coming on
is the
this only.
comparability.
Mm.
Also, as I told you in the beginning of the session, the short, medium, long term, the company fails to disclose the short, medium, and long term impact on it. Had that been the case, maybe they could have been a gold or platinum or whatever category awardee, and maybe they must have looked more compliant because there are other things to it also. Now we have a banking company, right? Uh, Now, with this, you can see all various stakeholders capturing has been done. I like one thing with this approach. As we're progressing on each table of content, the idea is to show you a better value creation model. So here the risk is also captured. Here the stakeholders are also captured. Here the sustainability goals to that extent. As I told you, it is related to the sustainability report, so we have to think about that also. Uh, Again, another model of an IT giant looks nice, looks very crisp, easy to understand. But again, there are issues as far as two, three things are commonly coming up. The comparability, the long term, medium term, short term things, right? Now, again, a conglomerate, I they have not presented a business model itself. They have presented their activities as a part of the business model and the inputs and outcomes linked to it. So with value creation model, I would want to say few things. Right, there are certain things which is very important as a part of an integrated report. As I told you, we discussed, and then we come on the financial part very quickly. As we discussed the organizational overview, the external environment, the governance and business model, important things. Huh.
Ankit ji, we had a discussion, I think, last year also. Is it right to mention the ATMs in the manufactured capital, or we should that where they have not given, I think, the capital? What is the confusing state of situation? Last question on
Kuldeep,
this non-financial part.
so your question is whether it is right to mention the number of ATMs as a part of manufacturing capital for a banking company. So you tell whether it is a manufacturing capital or not. I don't think somebody has rightly captured it. But the problem is the framework gives you that kind of flexibility itself that somehow down the line somebody can come up and start quantifying it. ATM is not a manufacturing capital to our belief system, but there is no law to benchmark the same that how do we capture it. But for a banking industry, I will strongly recommend to exclude certain things. This is not what is helping you to generate more capacities in terms of banks.
So when you go to the next sample that you have shown, I think there is no manufacturing capital in that particular. They have clubbed the natural and manufactured capital.
So the problem is that
again it
as
is
as a service industry, they find it challenging. They find
Agree.
it challenging, right? But as a service industry, the human capital should have come very well. So the intellectual capital should have also been defined in a better way. So all in all, few things, Kuldeepji, which I want to come out strong and saying major misses, the risk and opportunities sometimes are missed, completely missed in the section because they're taken into the MDA section. The risk and opportunities in a tabular format with a strategy to mitigate those risks with correlating it with the materiality assessment is what actually a risk matrix is all about when it is about integrated reporting, right? This is a non-integrated report, so please don't look at this slide. This is a non-integrated report. This is not the right. This is not a structure. I'm changing the slide itself, right? So next is the strategic and resource allocation section. So here we see it is just a part of it. it is also not the righteous way, right? We have to start deliberating how do we strategically allocate a resource, right? Most important thing, even we were having fantastic discussions with a lot of corporate reporting teams in last week, and none of them were able to give a clear explanation as to why the performance of capitals are not coming up.
Not coming out.
Ideally, you should introduce each capital, give a performance to it, and the performance has to be comparable in short, medium, and long term. A lot of companies fail to, majority of the companies are failing in giving the performance of their capitals. The outlook and basis of preparation is okay, coming out with a forward-looking statement, but still, I think there are a lot of gray areas into this entire section of the report. Everybody has to pull up their socks from the corporate reporting teams and from the auditors who are giving assurance on the non-financial information, even though they are giving it on for as far as for BRSR purposes. But let's pull up our socks in terms of uh, putting the right framework at right place with right spirit. That's for integrated reporting framework. Kuldeep, I'll take another 2-3 minutes and then we will jointly deliberate on the financial side. Right. This was an awardees risk awardees MDA section which I tried to capture out. Right. The way they have given their risk and concerns, I liked it. I like the format of the entire thing, and that's why sometimes people write so much of text about their internal controls, about their risk. You have to come out with the risks which are aligned to your risk management policy, the risks which are benchmarked to the global framework, be it ERN 2017 or be it any other risk, any other framework. Uh, I like the way they have talked about their internal control systems. How are they reviewing it? How compliant they are into? What are the control functions? Right. So merely an internal control system is in place will not suffice. Why not come out saying strong to our stakeholders that there is a mechanism to it, and defining that mechanism and benchmarking that mechanism is what is expected to be done. Kuldeep ji, with this, the non-financial part, to the extent possible, we have not covered corporate governance. We have not even covered the statute-based requirement of management discussion and analysis. But to the extent time permitted, both of us, we have tried to deliberate on it. Rahul, do we have any questions for non-integrated section or for integrated section?
Yes, sir. We have questions for integrated reporting. So, Ekta Shah has asked, what is expected in value creation model?
So IR gives you a framework. I told you that there are 3-4 things which are expected while I was explaining this. So value creation model has to be linked to your business model. Number one, has to talk about the strategic initiatives you have been taking in terms of uh, integration of your integrated reporting practices. Have to deliver, have to link it to the three objectives which we were discussing: short, medium, and long term uh, goals in that model, so that the impact on capital is rightly depicted. There has to be an input, there has to be an input to these six capitals, there has to be an output to these six capitals. They should be correlated to, and that's what the framework talks about. uh, and we'll keep another session, Rahul, for the entire only framework of value creation model, linked with the sustainability goals, linked with the stakeholders approach, linked with the the stakeholders you have identified. So that's why that there are so many things to capture. It needs to be very meticulously prepared. That's the only thing. But these are the minimum things you should start capturing in I would again say, please don't capture your value creation model in A4 size, because then you have space limitations and you have a single page to give the performance. That's something which is very clear. So capture it in 2 A4 pages of your annual report. That will be we will be able to capture the capitals also, we'll be able to capture the business model also, and we'll be able to capture the output also, the stakeholder also, and linking it with the United Nations sustainability goals. Next question, Rahul. Hope Ekta, it is clear. Still not, you can write back to us. I'll put up entire framework on email to you.
Sir, Mr. Jamshed Udvadia has asked, what is the reason of such non-compliances that are being shown as example? Is it lack of knowledge, understanding, or lack of training, resources, or any other challenge?
I'll answer this, sir. I think very well said, and that is why this triggered us to straight away discuss the practices. Let me answer this. Number one, I think those companies who are preparing their reports in-house either lack the resource capabilities who understand these frameworks. So naturally, the trainings, the inductions of these resources needs to be done. The other thing which I felt was that where these reports were outsourced, uh, the branding consultants and everyone, in preparation of the report to make it more interactive, make it more fancy, pitched wrong things to the corporate reporting teams. The third is naturally, as professionals, it is a failure on our part also that when we put up something in this document, we don't look into the law too seriously. As we look on the financial matters, and there are no auditors to this thing. The problem is that while you will be preparing your financial statement, it gets cross verified through your auditors also. Management prepares it, auditors verify this. But these are grave mistakes. I feel that we should just not look into anything, just look into what the framework is. The framework is an easily accessible framework. You require no consultants for it even. Easily accessible frameworks, just benchmark it to a framework and then guide it to your branding consultant or your internal reporting team to create a graphic on it. Reports will start coming out in a better way. Any other question, Rahul?
One more question. Ekta Shah has asked, what do you mean exactly by process disclosures?
So process disclosures, when we look at the IR framework, so this talks about the processes you have adopted to prepare an integrated reporting and the integrity of the integrated reporting. A process like where you are talking about this internal control system and their adequacy is a process which this company mentions. Similarly, a process needs to come out as to how this integrated report was prepared and what steps and processes were followed to ensure that the integrity of integrated report remains well. Hope Ekta, I was able to answer this. So there has to be a 2-paragraph statement or a depiction of a process why this report is considered to be in compliance with integrated reporting framework and how you were capturing all these things. What was the process laid down by your company?
Thanks, sir. Sir, we can proceed further.
Okay. So next, we move on the financial side of it. Kuldeep ji, are you joining me? I think we lost Kuldeep ji in between. I'll start deliberating on the financial side of it.
Sir, he is having some technical issue in its end. He is looking into it.
Okay, no worries. I'll try to deliberate on it. So number one commonly found error which I feel Rahul and everyone in the session is the nomenclature. This comes from a listed FMCG conglomerate only, right? And how many times we would have deliberated any wrong nomenclature is a problem. Here, the company writes cash flow statement for the year 31st March 2023. I am saying let's map the reviewer's perspective. This is as basic mistake as somebody can do, right? So as per Ind AS, we know it's the statement of cash flows. So all these basic mistakes needs to be eliminated, be it wrong nomenclature, be it wrong writing of an accounting policy. This year, when Institute considers for awards, I think the material accounting policy change will also play a very critical and important role. So I hope the learned audience is aware that there's a change which took place on 31st March in Ind AS 1 and Ind AS 8, which talks that as of now, all the companies were writing about their significant accounting policies and estimates. And now, henceforth, this has now the companies are expected to write their material accounting policies and estimates. Your company's accounting policies will undergo a lot of changes. There's a 5-layer testing system which this circular provides, and then only you are advised to disclose a policy or not. Now, the intent of the law is what I understood is obviously to not give redundant disclosures. Also, the intent of the law is that you can't give obscuring disclosures. For example, if in a financial instrument disclosure, you give a disclosure of the fair value hierarchy or fair values of your debt instrument in which you are not in possession of, then what is a logic of doing that? So what has happened over a period of time, and this time that is why you don't see more gold awardees, because we were very clear on one fact that if a disclosure is redundant, if a disclosure is obscuring the user of the financial statement, we don't want you to overly disclose anything. We want you to disclose based on the sensitivity and based on the items you genuinely possess. So so make sure that this is the year. If you want to get rid out of few policy and don't want your auditors to object on the same, this is the year to implement this change. There will be certain policies which you can definitely move out. So this is important. So wrong nomenclature is important. Wrong referencing of accounting standard is is a problem. And Kuldeep, you have joined.
Actually, hold on for a second. I'm trying to just join. Yes, yes, fine now. I'm really sorry
We
for
found,
the distance.
no, we found you. While the financial came up, I was like, I need your help.
Mm. Yeah, I
So,
know. Sir.
so I was saying a wrong nomenclature or a wrong, reference of a paragraph is a grave mistake, and you makes you ineligible only. Still, Kuldeep ji, please.
I would like to add one thing to this, Ankit. I think Rahul, you will also, support this. That while we were discussing the commonly found error last year, and we had, I think, almost 12, 13 odd webinars throughout the span of 6 months. Still, we have seen this mistake in many of the companies. And as we were, compiling the compendium for the commonly found errors, unfortunately or fortunately, we were forced to put this as a commonly found error, because at the level at which those, without naming any company, those companies are operating, this is something which is a very, very grave mistake, as rightly mentioned by you, Ankit.
So next point, Kuldeep ji, you can take it from here. I'll pitch in wherever required.
So this is again a very interesting, error or dilemma, I would say. These sort of requirements come out of the amended Schedule 3. So when you see or when you interpret the Schedule 3, or you go by the notification issued by the MCA, then you will come to know that yes, I need to give a statement or a table presenting that whatever title deeds are there, which are not held in the name of company. And whenever we deliberate this with the corporate reporting teams, also they say that the similar kind of disclosure is coming out in the auditor's report also, or the annexure to the auditor's report. But what do you understand by giving a reason for a property not being held in the name of company? Is it the way that the companies are doing, like writing pending litigation? Rahul, you remember when we were discussing this particular point, Ankit, you will also appreciate the fact that we have quoted a specific paragraph of amended Schedule 3's guidance note issued by ICA only. It is clearly written, if it is due to a litigation which is going on, then you need to mention the state of litigation and at what stage it is there. So this is probably not the rightest way, but I would say this is near to
Correct.
what the statute requires.
I have changed the slide. So there comes there are two, three kind of mistakes. What Kuldeep, because your voice is breaking, so I'll try to interpret, what you're saying. One thing what Kuldeep wants to put here is that a lot of companies do not disclose the reason. So that's a mistake one. That's a bigger mistake. The other problem is when you state a reason to this, right? Then you say that the reason is a pending litigation kind of a reason. That is not a reason, that is a state of affair. Whereas when you look into a better practice, right, you will find a more comprehensive response. The intent of the law and the spirit of the law has been adhered to major extent. He still feels this is not the best ones, right? But this is a more appropriate way to do that. The best is how transparently you can say about, a reason for not being held in the name of the company for a title. Kuldeep, shall I move ahead? Because
Yes,
we have like 50 points to discuss. I don't know how do we do that. Rahul, you have to keep this session for 4 hours. This can't be done. We are rushing up things. I am not happy.
Definitely, sir.
So-
We will take care next time.
So do it very fast. Another 2-4 hour session. So now next is Sosi, right? Kuldeep ji, please.
This is again a very interesting observation that we have came across while reviewing the reports. This again comes out of the requirements of amended Schedule 3, and I think you will find it in almost all the reports because it is part of the reporting requirements also. But there are two sort of errors. I think the first error we have you deliberated on the same in last year's webinars at length, I guess, that the companies are failing to provide the prior period errors if there are any changes due to prior period errors, or there is any restatement, because when we are presenting this statement of changes in equity, Ankit, we would like to bring your attention to the fact that there is a specific format which is given by the statute. And again, I would refer not any model financial statement, not any external guidance, but I would refer the guidance note issued by ICI only. There is a very
Correct.
specific
That's the way.
explicitly it is coming out that if there is any changes on account of prior period error, or there is any restatement, then it has to come in the format as being presented by the other company. Or if there is no such errors or restatement of balances, then you need to give a positive affirmation about the same. But
Correct.
second mistake is something which is, I think, if you ask me, we have tried to find a peer reference for the same. But you ask me, there is no exact or correct rightest peer reference for the same, because when you see how to present the other equity, it is again clearly mentioned, Ankitji, that only 4 things can come on the face of the other equity disclosure under reserves and surplus: securities premium, capital reserve, returned earning, retained earnings, and other reserves and surpluses. So anything other than these 4 things has to be shown under the head of other reserves and surplus. And while trying to present this statement horizontally and vertically and giving the reconciliation, I think this has become a mess, totally mess. So this is not solving the purpose with
Of the
what
law.
the statute has mandated the same. Would you like to add something to this?
Kuldeep ji, we are running short of time, but I have lot of, we have tried to capture a lot of statement of changes in equity. I'll straight away come on, the most appropriate, which we felt, right? I think Kuldeep ji, this is the most appropriate, and this comes from Tata Steel, because somebody who is coming up with great practices. Let's appreciate that fact, right? So that's how it needs to come, and look at how concisely this is coming up, and more compliant. Why, I don't know, the other reserves are coming horizontally or vertically, but we were not able to figure out a reason. But this needs to be in compliance with what the amendment schedule 3 says. Kuldeep ji, over to the next point, right? If anybody has any questions, because ultimately the session gets over at 4, so we'll try to deliberate on maximum things. Kuldeep ji,
Hmm. Any questions, Rahul, as of now?
No, sir.
No questions?
No, sir.
you have to take it faster. I am telling you, because you're not even with
Again,
half the presentation.
again, this error was deliberated in last year's webinars at length. The right way of disclosing the market risk, or the right way of disclosing the sensitivity analysis. What point we are trying to make here is that while presenting the market risk, there is a categorization which Index requires you to do. The risk has to be categorized into 3 parts: interest rate risk, foreign currency risk, and the other price risk, and all other risks such as commodity risk, or if you have any sort of equity investment or investment, say per se, then they need to come under the head of other price risk. So I think maximum of the companies are failing to adhere by this specific categorization requirement of the Ind AS. So when we say that you need to comply with the Ind AS, then we mean that you need to follow the terminology also, the terminology in the correct way. And when we talk about sensitivity analysis, Ankit, what interesting thing that we have seen this year, the sensitivity analysis of foreign currency risk. So the statute asks you to present sensitivity analysis for every significant foreign currency in which we have any sort of transactions or pending balances as on the end of the reporting date. So when you are identifying any particular currency as a significant currency, and I assume that is the reason you are presenting, the company is presenting the same in this way, and then you are giving a sensitivity analysis for only one currency, or you are giving a comprehensive or composite sensitivity analysis, I think it is not serving the purpose. Would
So
you like
it
to?
has to be done for no, it has to be done for significant currencies, right? Uh,
Will
we
will it
had a
make
discussion.
will it make any difference that since my reporting currency is INR, it doesn't make any difference in terms of the total impact? Will it make any difference, Ankit, or still you would say that it has to be shown for every significant currency?
So when you identify significant currency, the law clearly mandates you. So your reporting currency, maybe a value to a dollar or a value to a pound might be closely approximating, and that is why you feel that the net impact can be shown. Else,
Hmm.
my suggestion would be to take care
Hmm.
of this.
Hmm.
It's the
Which
same point. We have covered this.
same point?
This is a
Yeah,
better practice.
better. No, it is not a better practice. What point we are trying to make
Oh,
here?
this is right,
Composite
right, right.
composite
Got
disclosure of the gains and losses on account of sensitivity. So this is
right,
again
right.
not the right practice.
Okay. So then for other price risk, interest rate risk, this is a silver awardee practice. Doesn't exempt him to, exempt him to give sensitivity. We still feel that these risks needs to be properly bifurcated, categorized, and the sensitivity of the same needs to be done.
Hmm. And
Cool.
this is again a very interesting and a new point that we have came across while reviewing the current year's annual report. You would go to Index 7 when we evaluate the statement of cash flows or cash flow statement. We see that there is a table coming adjacent to the cash flow statement of cash flows, reconciliation of liabilities arising out of financing activities. So it is, friends, it is a statute-backed requirement. It is given in para 44 of Index 7, and it says that if there is any change on account of financing in liabilities on account of financing activities, then you require to give a reconciliation. And if it is not so, then you give a positive affirmation. And again, if I'm not wrong, Ankit, it is a reporting practice of a silver awardee where they have given that there are no borrowings in the current year, and hence that debt movement was not shown. I am right?
Correct. Correct. That's the heading which is given.
Hmm. Again, it is something which have been newly discovered by all both of us. It comes out of the requirement of Ind AS 115. The para 126 AA clearly says that you need to present a reconciliation of gross revenue with the revenue from contracts with customer. And when it talks about adjustments, it talks about discounts, it talks about any other adjustment, it talks about rebates, schemes, or any sort of variable consideration also. So what we have seen is companies are not presenting either separate sort of adjustments in this reconciliation, or if they are
The
not.
first problem is that company are presenting this net of discounts,
Yes, yes. Hmm.
which was a matter of concern. The second is an excellent practice. Sorry, I pitched in between because then I recalled the
Hmm.
work that companies why there's a clear requirement of India's 115. Now the
Hmm.
second thing what Kuldeep ji is trying to deliberate is the categorization as per India's 115 for each of the adjustment. The
Hmm.
adjustment which we are making for discounts, the
Hmm.
adjustments which we are making for rebates, the
Hmm.
adjustments which we are making for incentives. This can't come together.
And one more thing, Ankit, it should be not with the qualitative data also. So I agree that when we deliberate with the industry at large, they say that it is because of their business secrets. They cannot give the. I would say that at least on the broader side, you should give a qualitative detail about what sort of adjustments or what sort of discounts, rebates on in what class of adjustment you are reconciling your revenue with the contracts. We can move on to the
Correct.
next. This is again a correct way of presenting changes in liability arising from the financing activities. So there are two sort of error, Ankit ji and Rahul, I would like to mention in this. That one error is that companies are not presenting it at all. Second error is companies are presenting it as shown in the slide below, that they are presenting the changes on account of cash flow or non-cash flow uh, at gross level. So ideally, it has to be in the way that receipts and payments or any sort of positive and negative changes are to be shown separately. So there are two sort of errors or problems that we have seen and we have encountered while vetting this particular disclosure as per Ind AS 7.
Rahul, are you receiving some questions because we are moving faster? But I hope with the note present in front of them, it becomes easy, right?
Sir, no question in respect of
Please,
financial statements.
please start putting up your questions. To the extent we are able to deliberate it today, we'll try to have one more session specific to financial again, and the other, non-financial part which is not being covered today. But in meantime, you can keep on posting your questions pertaining to any index which we are deliberating for next 5-10 minutes.
Again, this next commonly found error, or I would not say it is a commonly found error, but it is a rarely found error, but very grave error. So when you see the requirements of amended Schedule 3, it gives you certain additional disclosure which are required to be made as per Schedule 3 under the head of additional regulatory information or other statutory information. In my opinion and in my understanding, and I think you will agree with to this, Ankit ji, that in no case Schedule 3 exempts any of the company to done away to not to present these sort of additional statutory disclosures or positive affirmations. One question which comes in my mind, and I would like to take this answer from you, that some of the companies says that the same thing is being reported by the auditors also in the annexure to the auditors report or in the Caro report. Will it exempt me from giving these sort of disclosure? What is your understanding on
So,
this?
so it is clear this disclosure is a management-based disclosure. The auditor's disclosure are governed by the relevant sections of the Companies Act, which is fine, right?
Mm.
But it is something, as while you are the preparators of the financial statements, you have to take care of these additional disclosures which are put up by Section 186 or which are put up by Regulation 35 of SEBI.
can I assume that if there is no Benami transactions, or if there is no any sort of penal proceedings going on me, then can I assume that I should not present this disclosure? Is it
You have
possible?
to give no. You have to give it in a separate section and assurance over it.
So I understand that it is not a positive affirmation; it is a mandatory affirmation.
Mandatory, yes, yes.
Hmm.
Even if none of it is applicable, right?
Ankit, would you like to, I think since we are running short of time, would you like to put some light on the intangible assets index? I think we
Uh,
discussed quite
we
large.
had so by and large there are a lot of things which are left, right? I'll sum it up. One, NAFRA issued an advisory
Hmm.
on PSP projects regarding to disclosure of provision metrics and in compliance to IFRS 9. A lot of companies are still failing to give their provision metrics. That's something which will require a meticulous exercise. And while you are closing your annual reports, you have to start looking forward for provision metrics. A provision metrics also needs to be in an appropriate format which needs to be in compliance with IFRS 9, capturing the collections, the number of days. So as I move forward, it's a better practice. As I move forward, it's the one of the best practices, the silver awardee practices as to how do you give a provision matrix. So with ECL also, there are certain things as we were discussing in the last section. Was very happy to find such kind of disclosures. It's a positive, better practice where you are giving your ECL in terms of your security deposits, the other financial assets, right? Based on this, a lot of companies are not able to give these kind of comprehensive disclosures. Interestingly, one thing I want to cover, Kuldeep ji, right? So, so sometimes it is about the presentational aspects also. So I'm not saying, something is correct or incorrect, but, with this, we can sum this up also because there are a lot of things I am telling you, but I can sum this up. If you want to map a awardee's perspective,
Hmm.
correct, Kuldeep ji,
Hmm.
then at least make sure that your note is not cluttered, right? So that is why in today's era, there are the forward-looking companies have
Hmm.
started presenting their policies and notes together.
Hmm.
So that one, there's no redundancy in the information. Two, there is no obscuring information coming up.
Hmm.
Now, when I look into this entire note from a
Hmm.
listed conglomerate,
Hmm.
I see all Indias, coming at one place, right? Now my problem here is,
Hmm.
Kuldeep, tell me if I have to categorize these intangibles between something which I have acquired
Hmm.
internally
Hmm.
or which I have, acquired through a business. Oh, sorry, I have generated internally, acquired through a
This combination.
business
Hmm.
business combination,
Hmm.
right? How do I do this in this election? That means my intent is not to do this.
Nee, I would
How
like to go one step further than what you have said. That looking at this note, what I can assume, or with what I can conclude from this, that I think all these certain subheads or certain sub notes, all these comes out of from a different indices disclosure. So
exactly?
in my
Uh,
opinion, you cannot club the disclosure requirement of two not mutually
that is
exclusive.
why I'm saying half
Hmm.
of the Indias have been compliant under one note only, right?
Uh,
Now my problem is now if I have finite and infinite life intangibles, how do I show that? If I have to disclose a research and development expenditure pertaining to intangibles, how do I show that? Right.
how can
If
I
I if
the
I have to if sorry to interrupt, if I have to disclose the carrying values
Hmm.
of significant intangibles, how do I show that?
Hmm.
If I have to talk, if I have to talk about a borrowing cost being capitalized under PPE,
Hmm.
how do I do that?
Hmm.
If I have to talk about the PP which has been pledged as security, how
Hmm.
do I do that?
Hmm.
If I have to talk about, invest my right of use assets, right? And if I have to talk about them in the compliance of India's 116, as to what are the short-term value lease, low value item lease. How
Not
do I do
perfect.
that? So,
There are
so
two ways to do.
also, every Ind AS mandates me a different thing. PP mandates me to capture a commonly found error. Lot of people write accumulated depreciation, amortization, impairment. Everything is not depreciation, amortization, and impairment. The senior guys have to understand this thing. The idea of the law is to capture accumulated impairment. The idea of the law is to capture accumulated depreciation. Please go back and look into your balance sheet. How many of you are able to capture this appropriately, and then the disposals and everything? Now, if I have to give life of an intangible, how do I do that, Kuldeep ji? Remaining life. Generally, the expected life comes as a part of policy, and the remaining life of an intangible comes here. So, so my point is, every index has a different uh, requirement, disclosure requirements, and that everything can't be cluttered in a footnote. There was a footnote attached to this also, but uh, but we should start taking these things very seriously to win an award, right? Or forget award. This is to be more compliant. Tomorrow, the auditors, the NAFRA, and the auditors of these entities will be scrutinized. Where are you talking about the revaluation of intangibles? If there is any revaluation done. So I like there are certain good notes also. I have not put into, uh, but my point here is that this entire preparation of notes to accounts, the material accounting policies henceforth is a meticulous task. My request to auditors is please don't rely on managements to do this. Sometimes even this is outsourced. My request to management is don't rely on auditors to think that you have big name auditors exempts you from all these hassles. Tomorrow, if a regulatory affair comes, it comes on everyone, right? Be it auditor side of it or be it management side of it. We have tried to extract it, annual reports of those companies which are, which are significant companies, which contribute significant to the nation, to the entire economics of this entire nation. My simple request here will be, please, when you benchmark a note, stop a 3/4 takeaway. Stop benchmarking it from a peer. Not necessarily it is right. I was looking at some IT giant, intangible assets. One wrote that we have customer related intangibles. The other gave the description of those customer related intangibles. Where does the spirit of para 119 of India's 38 stands? So the logic is those who benchmark law will suffice, will be awarded, will be rewarded, will never be in the hassles of any regulator. Institute fears a factor that even tomorrow somebody's report looks very glorious and glamorous, gives them an award, and a NAFRA issues an advisory on that particular entity, makes tricky for ICI also. So these notes needs to be meticulously worked out in alignment with material accounting policies, and there has to be a rigorous interpretation of law. Some positive disclosures based on sensitivity needs to come out. For example, if your intangibles don't constitute too much of your uh, are not too significant for you, then I am fine even if you not put up a note on revaluation of surplus or revaluation of it. But if it is a significant intangible, then it needs to be there. If a significant intangible is of infinite life, then it has to come out. The note should say what the actual accounting policy and practice has been followed. So for all those who think that we missed out, I think this is just a beginning. The idea to recognize this always to elevate the practice, not to demotivate anyone for not taking a participation and putting up. But let's look into ourselves before we feel, because as professionals, it's a common problem. Kuldeep ji, I find that I told you, people think we have bigger auditors. very seasoned auditors, or people think that we come from a great, we are doing this since years, but maybe that has made us more inflexible in terms of adopting the newer frameworks. Let's try to embrace the newer non-financial framework, and let's try to be more compliant with the financial framework. Award is a byproduct. You will feel more compliant and more confident for your annual reports. That's all from my side. I would want to hear Kuldeep ji for his concluding remarks. Thank you so much for coming up in such a huge number, and we'll constantly keep on doing this. We'll try that, unless we reach to some level of good financial reporting practices, we will work harder for this thing, but for which we will require your support for sure.
Thank you, Ankit for your wonderful deliberation and taking the extra pain when I was not available due to some technical glitch. As you have rightly mentioned, I would say that since the reporting season has already begun, since it is the first year in which we are going to implement the material accounting policies, the reporting will become more tricky for both auditors as well as the companies, because it is clearly written in the new mandate that the information should not be obscuring in any way. So when I discuss, when we tell that this is to be presented, this policy for the intangible assets, how to define the finite or infinite life assets, people are writing indefinite assets, or people are giving what sort of treatment that they followed at the time of transition to Ind AS. I think these all things will become obsolete per se from my perspective, and you need to minutely look at each and every accounting policy, aligning it with the quantitative information that you are giving in your notes to accounts. And I would say that, as you rightly mentioned, a very good reporting practice will be that you start presenting your accounting policy along with the notes to accounts, so it becomes easier for the stakeholders also to take out the information out of the same, and you don't miss out on anything. So there could be a case when you amend your accounting policy or you change your accounting policy after the mandate of material accounting policy, and something other is coming out in your notes to accounts. And the last thing which I would like to add, I always say there is a very thin line of difference between excellence or best practice or at par practice. So you should always strive for the excellent reporting practices. Award is and will always be a byproduct to the same. Always aim for being more compliant and being reporting with more transparency. That will fetch you more and more awards and more recognition. With these words, I thank you all participants as well as the research committee, our honorable chairman Anuj Goyal sir, whole team, Neha ji, Rahul and other team members, secretary Amit Agrawal sir, and my co-speaker Ankit ji, for taking the pain out and compiling this PPT in very short span of time, because since we both were traveling and I was at some other place, he had to do this extra work or one extra mile for compiling this PPT. I thank you all on behalf of both of us. Over to you, Rahul.
Thank you, sir, for the insights and such a wonderful session. On behalf of the research committee, I would like to extend my warm gratitude to our esteemed chairman, CA Dr. Anuj Goyal, sir. I would like to place my deep gratitude towards both the speakers for sharing their wisdom and sparing valuable time throughout on the various topics of excellence in financial reporting. The journey of learning keeps going on. Wish you all a happy learning. I hope you all had a great session. Thanks.
Rahul, lastly, if you have some questions which are unaddressed, please mail to us. We would want to
Sure,
revert
sir.
on that. Right? You
Sure.
please give them reverts. Right? Okay.
Sure.
Thank
Sir.
you.
Okay. Thanks.